The reason you're getting taxed is because you're making too much money and IRS just wants to invest it back into the economy. So if you can invest it back into the economy, they're fine with it. But if you cannot figure out how to invest back into the economy, then you better hand it over to the IRS.
Welcome to Carry On with AJ, where serious capital meets honest conversation. Each episode, we sit down with investors and operators to unpack the decisions behind long-term success. Welcome to today's episode. Let's jump in.
I'm super
Thanks.
excited for this show because we really have a lot of interesting tax related questions and we're in the prime tax preparation season. So it's going to be very beneficial for whoever is listening to this. Before we dive into specifics, I'd love to first welcome you, ask you to give us a brief introduction about your background.
Absolutely. So I'm Abneet Kaur. I'm the CEO of Fractional Family Office and Global Investment Capital. My background is, I mean, we could start where I was born, but I'm actually an Indian
Sounds
resident
great.
that got relocated to the US because my parents decided that there's a land of opportunity. Ended up here when I was 17, been in finance, since then. My dad set up a brokerage and we've been doing lending as a family since then. My personal background, I ended up at UCLA, ended up at Wall Street doing the whole Lehman Brothers crisis time and learned very
Yeah.
quickly that wealth managers are not necessarily getting a holistic opportunity to their clients, and neither was the lending or the real estate industry set up that way. So in that pursuit of finding transparency and a holistic solution for myself, I've been working at this solution since 2009 and finally
Mhm.
ended up with a family office model on the retail end. And now I run this and basically focus on tax reductions, investment strategies, structuring, and mostly a holistic opportunity for a person who's earning their wealth to build a legacy.
Yeah, sounds great. So I like to start with a real example. Before somebody working with you and after somebody working with you, what was the tax outcome has changed?
I don't even take on clients if I can't change the tax outcome. So I do a pretty heavy intake and understanding what's actually happening to you. If I take you on as a client, my intention is to
Yeah.
reduce taxation. On an average, I save about $1 million. And that's because most of the clients that I'm picking up are paying seven figures in taxation. And they're either not
Mm,
structured correctly or they have missed an opportunity somehow, or they're high W 2 income earners that don't understand the other IRS codes that could actually help them. So, on average, I'm saving anywhere from half a million to $2 million in taxation. That's my daily bread, as I call it. Keeps my lights on. But before, usually, I'll give you a quick example. I had a surgeon making 5 million through his different practices. When we were done with him, he reduced his taxation from $1 million to 125,000. So that's a quick before and after
wow.
for you, and a very simple what's happening to an average Californian resident.
I hope average California residents makes $5 million a year. First of all,
Here they are
but
in
what
LA. In LA, Silicon Valley, very normal.
what is the typical client profile that you're working with?
A typical client profile right now is paying heavy taxation. I don't really focus on how they're making their money because that could be
Okay.
varied. I have a manufacturing company. I was talking about surgeons. I'm Indian, all our Indian people are surgeons or engineers. So I deal with high W 2 income earners. I deal with passive income earners, which are a bunch of K1s coming in and they might not have a very high ordinary income tax bracket. I also deal with just pure investors on that K1 where they're invested in a whole bunch of different things and they're just earning passive income. So that's a real cool niche. So between, I would say, ordinary income and passive income, I'm just focused on what are they really paying for the taxation. So an ordinary person for me is at least paying half a million and upper in taxation, but I'm not really industry specific. I would say I'm industry agnostic just because of the pain of taxation is not limited to the industry, right? So that's what I'm focusing on.
Yeah. That's interesting because a lot of people only focus on the business owners, which, have a lot more room to adjust their tax strategy. But for
Yeah.
W 2 employees, what I heard is you have less flexibility. So what I would like to do is to unpack three rows. Let's assume they're business owners, W 2 employees, and specifically in the Bay Area, I would like to ask tech people with equity package, how would they do it? So let's start with the business owner. For people who make above your income threshold, what tools do they have to utilize as a tax reduction tools?
Business owners are the luckiest because the IRS code is actually set up for business owners. So, as a business owner, if you're still paying multiple seven figures in taxation, you're definitely doing something wrong. And it's sad because our CPAs are mostly acting as historians and it's not their fault, but they're not strategists. And actually, the younger generations of CPAs are realizing that and are working on it. And they see that they're not just historians. So, I really focus on business owners and how they're structured. The biggest opportunity for business owners is to not have multiple S corporations, which is like the most common problem I see. In fact, I had this business owner who's an import export, has 13 S corporations, and yet
Mm.
cannot set up a good defined benefit plan for themselves because they have 50 employees. They're not able to tuck much away except for just a 401k. Same problem, IRS guidelines. Really needed was a holding company that is not an S corporation structure. They can also dive into the trust solutions. There are a bunch of trust solutions and also philanthropy solutions because a bunch of business owners that are making that kind of income tax are already understanding that there are charitable deductions that they can tap into. And so I really like to talk about if you're already charitable minded, then we could talk about some philanthropy solutions for you too. So I feel business owners actually have the most amount of solutions available along with proper structuring. So I don't want to just see where your money is coming from. I actually want to see
Mhm.
where you're sitting. How are you structured? So having multiple pass through entities is not ever going to be a solution for you. And that's why you're in that rat race of going back and forth with your CPA and saying, why am I paying so much taxes? I have these many entities. Well, LLCs and S corporations are all pass through. Anything that's happening at that level is happening to you. That's why anytime you do something unique for yourself for retirement planning, defined benefit plans, cash balance plans, as you hear, then you got to do it for all your employees. And you might not be a business owner that can afford that. It's kind of like a catch 22 for them because they just don't understand why it's happening to them, but it's actually because they're structured that way. So I really want to hunker down and figure out what structure is best for them. A really quick and easy thing that business owners often tell me about is how they bought a G Wagon or how they got hired their children or they got a health savings account or a flexible savings. Those are great options, but I call them band-aids. The bigger problem is the way the dam is constructed. You keep putting band-aids on those little cracks. It's a good solution for maybe temporary purposes, but the bigger issue is how you're structured. So we just want to focus on that for business owners to start. And we follow up with all the other strategies that are options.
Yeah, I feel there's a lot of tax tips, right? You buy heavy G Wagons, you do cost segregations. There's a lot of small tips. Maybe that's because it's viral and it's easy to remember. But I think from a high level, I would love to know what is the framework? What are the tools that is available as trust or entity setup? How would you construct it from the top?
That's a great question. Actually, going back to the top, the question is the holding company. The key lies in how the holding company is set up. So, a lot of times these guys are looking at, okay, what can I do in my business? Most of these entrepreneurs and business owners rarely just have one business. They usually might
Yeah.
have some real estate investments, they might have some other holdings or some passive investments. And so, they're not looking at themselves as a global solution, they're looking at a siloed solution. I want to look at the global solution, which normally lies into their trust, how their trust is set up, and how they're operating their business, and or their holding company if they even have one. The biggest thing is that the holding company cannot be an S corporation because that will bring us to the same problems again. So the holding company usually I recommend as a C corporation, and most of the CPAs
Mhm.
hate hearing that because they freak out. Oh no, double taxation. But what we're forgetting is that you are already living off the income that you're getting from your business. So what we want to hold at the holding company is not necessarily to live off of, but to rather invest from. I don't want to bring that money home. I just want it to be taxed at that level so that now I can take that money back out into the market and invest it. IRS is a very simple rule. The reason you're getting taxed is because you're making too much money, and IRS just wants to invest it back into the economy. So if you can invest it back into the economy, they're fine with it. But if you cannot figure out how to invest back into the economy, then you better hand it over to the IRS, right? Then they'll invest it for you. So the intention is that now at this holding company, I can buy those tools that you're talking about. Now I can strap in a real estate investment there. I can do a development project there. I can invest in other people's projects there. I can collaborate
Yeah.
and form other types of LLCs there. because the intention is not to live off that money. The intention is to continue to build that C corporation as a family entity. And I love the structure of a family office. So that is, I would say, the seed of a family office is when you already have enough money to live off of. Your business is already giving you enough income. You might be taking salary from your business, and you don't need more money
Hmm.
to spend. You need money to build. If you keep doing those S corporations, that's not going to be the tools that you need. A business owner that is paying heavy taxation, you need tools that help you reinvest into the market. So that's why I'm a very big fan of holding companies and trusts. And you could be offshore as an offshore trust, especially if you're a global family and a global business owner. But locally in California, just by that problem solve and using that, I can now utilize all sorts of different tools in that corporation. Not only that, now I can build out because C corporation is a separate entity. I can actually build things like defined benefit plans that don't affect the rest of your pass-through entities. I can build out family retirement plans. I can actually hire your kids there. I can actually teach them how to run what you're building in this structure because that doesn't affect your operations of the business that might be your livelihood, right? So you got to separate
Yeah.
and then be able to utilize tools and not just try to cram in all the tools in this one entity. I hope that answers your question.
That is very smart. And also, there's
Thanks.
one interesting comment that you made is if you don't invest the surplus you make, the IRS is going to invest it for you, which arguably is less effective and direct. So you
100%,
better do that yourself.
100%, right? You will never know what your dollars are doing when they go to the IRS. And that's why the IRS code book is written. You hear about things like a 401k, life insurance, annuities. These are actually investments addressed in the IRS code where you can utilize them to save taxation. These are not just words that the investment companies made up with. Their 401k is an IRS code, 403b are IRS code. In fact, a life insurance is 7702. These are sectioned out and they tell you how you are going to actually receive the money, how the money is going to be taxed, how many ways can you save your taxation? The popular terms make us think it's an investment terminology. The IRS came up with it, and it's nothing to do with investment, guys. They're just trying to make the AUMs. This is not about them.
Okay, sounds great. So for W-2 employees, what tools do they have? Can they form a C Corp or what do they do?
Yeah, so high paid, right? Well paid are often stuck because they think, oh my God, what will I do? But the very popular things that people are catching up on are things like short term rentals, Airbnbs, having a charitable trust, having anything where we're talking about strategies into building their own holding company for the assets that they already have, right? So you don't necessarily need to do things that are out of your scope. You might already be buying real estate because it is the way to actually invest and actually build your legacy, right? Long-term legacy is usually built through real estate. So all you really need to is structure that again correctly. Because if you're just buying them personally, consistently, there's only so many deductions you can take. But if you actually build a holding company and start investing through that, this is all post-tax dollars, right? W-2s unfortunately don't have pre-tax dollar options. That means once they're doing their investments, and they're still doing it at a personal level, that's going to hurt them more because then the income that's coming back is still taxed at the highest rate because it's ordinary income to them. So the intention is to separate that and to not get back into that, I call it a rat race, because everything you're earning is personally being realized. And then how are you going to run deductions against it? So to be able to run deductions against, to be able to take deferrals, to be able to take maintenance, let's build a structure where you go out and invest. And the intention is that when the money comes back to you, that instead of realizing it as 100% profit, you're actually able to put up expenses against it. You can't do that if
Hmm.
you're just Avneet going out and investing as Avneet. But if I have an LLC structure or C corporation structure, and even a pass through in that level, or even an S corporation at that level, something's better than nothing. So I will be able to build your assets and actually be able to give you that deduction on the maintenance expenses, everything that it took you to invest in that property. So I always say the first step for W-2s is real estate. Definitely the fastest way to earn depreciation, the fastest way to lock in some money in high growth areas. California, you might not get cash flow. In fact, you might even have to put in some money in California in A places to hold A properties. But the
Yeah.
equity gains are so high that it's worth it. And then once you have that equity built in, say you buy $1 million house, now that property is worth 1.5, guess what? You're able to take that equity out as debt, and debt is not taxed. So you can take that debt and now keep reinvesting. The intention is, how are you using that money that you already taxed on and using it wisely so that you don't consistently keep getting taxed on that highest tax rate? I hope that makes sense.
That does make sense. But what I heard is if you invest real estate, unless you're pretty active, a lot of people are not able to categorize as active income. So it doesn't deduct their W 2 income, right? Passive lane and active lane. How do people address that?
Yeah, active income is really hard to come up against when you're in W-2. The only thing that I can help you with if you want to knock out your active side is with philanthropy. I can help you build out your own charitable foundation, but if you're not charitable minded, the whole access of philanthropy just goes out the door. But if you are charitable minded and you're looking at CLATs and DAFs and all these types of trusts that go towards charitable or they go towards succession planning, you are able to offset your active W-2 income from that. But besides that side, W-2 income, usually I always say you're in the hardest part of the sector because there are very little things that can help you to reduce your active income. If you're
Mm.
charitable minded and you have done charity before, and a lot of Indian people actually have some version of helping their temples, helping the community. So I try to quantify that and build them their own private family foundation. And that actually helps reduce quite a lot of taxation on your active income as well. And the idea is not that you're going to set it up and then not do anything with the foundation. You have to be actually active in there. Otherwise, it's not valuable. You're just locking in your money. But there are
Mhm.
rules of being charitable within that space. I also have a few more charitable options where you can invest and then not necessarily donate, but you can continue to invest through that arm. But again, you have to be very careful with the kind of strategies that you pick because you could get into the audit report section where you better hope that all your filing is correct and you have some filing backups. You have people like us that can help you through the audit. I'm never afraid of an audit. The intention is not that audit is the boogeyman. The audit is just saying, hey, I need to see your paperwork, right? So your paperwork should be very tight. So for W-2, active income is tough to take down.
So we're just talking about the ways to reduce tax for W 2 and the charitable foundation initiatives. I'm in real estate. So I would love to understand how people can benefit from having real estate, both as a homeowner and rental property.
Yeah, I mean depreciation, right? There's a whole bunch of benefit in real estate. In fact, we're bullish on real estate not just because my dad set up a brokerage like 30 years ago. We've actually seen the effect of what it means to hold real estate long term. Not only do you get step up basis for your legacy building, you can definitely help your kids with it. You are also able to capture active depreciation every year on year, every year. Plus, there are awesome rules where you, even if you decide to sell your real estate, like 1031 exchanges, I love those. I've seen people go from a 5 unit entry level investment property to collecting institutional grade assets on 110 doors. It's one of those assets that once you get comfortable with it, the world's your playground. You can pretty much do anything with it. The only thing I tell you to be careful with is maybe any kind of recapture or something that you might not have planned in the sense where you're going for a high cash flow in an area that might not be something that you understand. So, I'll tell you some basic differences you already know in real estate. High cash flow, high cap rate means it's a little dangerous area. The only time I see people not get what they want from their investment is when they don't understand that high equity means low cash flow and high cash flow means dangerous area, low equity, right? So I
Yeah.
always try to distribute that kind of education before people get into real estate. I think it's a very valuable way to get started. In fact, I would say if you had to pick how to start investing, if you're going to pick like stocks, bonds, crypto, real estate, I would first say real estate. It's stable. It has data literally over 100 years. If you capture short amounts of data, also, it is good for your taxation. It's fantastic for your legacy planning. And on top of that, the intention of owning real estate is to buy, hold, and die. Okay. You never want to sell and recapture all of those taxations that would be due. You want to consistently do 1031s and keep increasing your assets. And literally, if you buy it and do nothing with it, in 5 years, you can upgrade that asset anyways, just because of the equity growth. So, not a lot of front education is required, just basic understanding to actually get in and actually get cracking and see those gains within 5 years. And it's a great tool for people who are already working full time, might not be able to
Mhm.
manage their, portfolio full time. It's almost like a set it and forget it asset. And especially if it's in your area, you're able to actually
Mhm.
manage it yourself. It's not as difficult as people make it out to be, especially if you're starting out with a single family home. But I definitely encourage real estate in all ways possible. Even if you want to, do fund investments and help other people invest and you don't want the toilets and tenants headache, right? But you can actually get the real estate exposure with good, strong developers on ground, people who are good in operations. I always am wary of fix and flips just because they're more market sensitive. But, overall real estate is a really wise decision. So yeah, all green lights. And I always start there.
Sounds great. I've run into people's mind debating when they have an incremental amount of money that they can be deployed into investing. When the stock market is doing very well, they wanted to join the stock market to pursue the high. Then when the stock market is not doing well, they already lost that money to investing in real estate. I've had people that always do not have money to invest in real estate. What is the right proportion ideally to have in your portfolio for real estate assets?
That's a great question. Diversification. Because of 2008, I realized the value of it because my family was 100% real estate and I was 100% Wall Street. 2008
Yeah.
really slapped that out of my head, right? So it's like, neither works. But the intention should be one third. So the rule of one third has actually been tried and tested. Not my rule. All the greats came up with it. In fact, the
Mhm.
idea is that you have $100. You're doing one third, one third, and one third. What does that mean? One third should be in a low risk, right? Like real estate. One third could be medium risk, potentially like the stock market. And one third could be in high risk, right? That high risk can be adjusted according to your age, because if you're 60 plus, you should not have as much high risk. It should be lower because you don't have that time to make that up. But in that one third category and the low risk, I put life insurance in that. I put real estate in that. I put bonds in that. And the intention is that I know that this is always going to be there. But with the stock market, I know that I need to give it time. Over a period of 20 years, your return can be 8% average, yes. But if you're chasing that high and you're trying to time the market, let me tell you, not even the greats can time the market. And a broken clock is still right twice, right? You
Yeah.
don't listen to people that say that I'm going to make you 20% return in the stock market or crypto, the 100% return right now. Those are speculative, not guaranteed, and need the timeline horizon. I always say like, you don't have to worry about, unless you're doing a fix and flip, you're not really worried about timing the market because it's a long-term investment, much like life insurance, long-term investment. And it's always guaranteed to be there. Once it's guaranteed to you, it's going to be there. But the stock market, if the company gets wiped out tomorrow, you're donezo's, right? So Lehman Brothers, all my bonuses were gone. 2008 happened. My bonus was in stocks and my actual 401k was in Lehman stock. And of course, a 120-year-old bank, you don't think that it's going to go boom overnight, but it's very possible. And it happened to me. So I always say, be careful. Then you want to go play in crypto and invest in some development or gold mine in Tanzania. You can take that one third and you can go test the market with that. But then you at least have those platform products at that real estate level, which is, you know that this is always going to be there. So God forbid everything wipes out. You have at least your life insurance. You at least
Yeah.
have the tangible asset, which is real estate. At least you could live in the house. At least you're not going to be completely homeless. I plan wise and plan one third. And also the one third rule also comes into your tax diversification.
Mhm.
You don't just want to plan assets. Yeah. You also want to plan your taxation in that category of one third. What's being taxed at the best bracket is surprisingly, again, life insurance and real estate. Fantastic tools for using in your taxation. And 401ks, not so great, right? They're just deferral products right now. And then eventually you're still going to have to pay your taxes. And if you're doing things right, you're not going to have lower taxes when you retire because your deductions are gone. You're probably paid off your house and hopefully you made the right investments to make more money. So the financial advisors in today's space are always trained to say that, oh, you're going to have less income in retirement, so you can take your 401k and it'll be taxed in the lowest bracket. Not if you're doing things right. So you don't want to go with that. You should be expecting more returns in your retirement. And because your kids are grown up and because you might have paid off your house, you're probably going to be in a higher tax bracket. So plan that 1/3 accordingly. And then the concept of that high risk, every time you make an investment or gain an investment, those are called live taxation. I can't save you from those. Those happen consistently and nonstop. And there's pretty much not much you can do about that. So the 1/3 rule comes in really handy overall.
Yeah, that's a good rule of thumb. It's really interesting. And this is actually my first time hearing it. So
Oh,
thank you for that.
really? Yeah. Well, I'm
Yeah.
not a traditionally trained advisor. I'm self-taught and made a bunch of mistakes and figured out, well, these are the things. And mentors like Warren Buffett and Ray Dalio and Alex Hermosi in today's world, you watch these people and you very quickly see what I'm talking about.
Yeah. And you mentioned insurance a couple of times, right? So they are part of the professional tax planning. But I think for most regular people, they're just treated as a risk management product. Things happen, so I buy insurance. How does that insurance product actually fit into the tax planning strategy?
I love life insurance. Actually, I think this entire thing got started because of life insurance for me. Because when I had my
Okay.
daughters, now they're in their teens, I was overwhelmed with this thought of the Cinderella story. What happens if I pass and what happens to my daughters? How do I protect those assets for them? Because, you come from any kind of wealth or just have whatever left behind and they're still minors and don't know much about life. They're basically prime target. You basically stick a target sign on your kids if you just plan to give them the assets. So I was really worried about that when this is like 15 years ago. Now I'm thinking, wow, like life insurance actually put me in this concept of legacy and protection. And that's actually how I came up to making this family office structure. But basically, life insurance is a tool. Yes, it is a risk management tool, 100%. But the way you can use life insurance, if you have heard terms like infinite banking, there's a whole bunch of ways you can use it. And if you're a business owner, you can actually use life insurance as a tax deduction tool. If you're a business owner today, you own real estate, you have, maybe a few other things that are investments, and you don't have life insurance, very high risk category because you have not mitigated any risk. And then a lot of people think, okay, I'll just get the term and then I'll invest the rest because that's the New York life
Hmm.
push. Not a big fan. The problem is that when you're young, your insurance is the cheapest. When you're
Hmm.
old, your insurance is the most expensive. And the term insurance policy is set up to only protect the asset while the asset has a loan on it. So if you buy a building that has maybe a couple of $1 million of loans on it and you want to protect that and hedge that because you are the one making those payments, great, you can offset the risk. But what I ended up using the life insurance was to protect my kids and myself and all the other people that I love and care about. Because life insurance comes with three guidelines. One, bankruptcy cannot touch it. And number two, a divorce cannot touch it. A 401k can be touched, but a life insurance cannot. Most of all, you can gift it to your kids as a legacy tool. So I brought
Yeah.
my kids into this zone where not only did I get myself a permanent life insurance, I got personally an index universal life, and I got the same thing for my kids.
So we were talking about life insurance. Three things that you talk about is bankruptcy protection. It was divorce protection. What's the third thing?
So the bankruptcy
Yeah.
is the creditors and creditors, right? The divorce protection is
Yeah.
like, God forbid you're going through a divorce. The third thing is that nobody can actually take it away from you. So if you're insured and you have a life insurance policy, nobody can take it from you. If you get into a lawsuit and you've lost everything, and this is kind of a part of the bankruptcy side, but this could be just a litigation, like just pure litigation can't take
I
it away
see.
from you. So the protection built in is fantastic. And the overall nuanced version of this is that this is income tax free money. When you put in an index universal life, because that's what I have, I also use whole life products quite a lot because a whole life product actually gives you a 4% guaranteed on your investment that you put in there, along with the protections that it already offers. And if I put it into a defined
Hmm.
benefit plan instead of a 401k, it actually gives me 50% off my taxation. IUL only gives me 25% off my taxation when I use it in a defined benefit plan. So how the product behaves inside tax structures also matters. I have a client who hates Ks and doesn't want the market access at all. So I took the same for the structure that a defined benefit plan has, but I only put in insurance products because they're set it and forget it. Life insurance on the whole life side and the IUL side
Mhm.
give you the same protections, but the benefit of the IUL is also now that it gives you critical care. So while you're alive, God forbid something goes wrong, you can actually take the death benefit up to 90% you can take out depending on how sick you are, and you can use it for anything. You don't have to use it for medical bills. You might have great insurance. You can use it for things like mortgage, travel, kids. There's no restriction on how you use that money because it's your money. So when I got that IUL, my intention was not only can I help myself and not get a disability insurance added on top because the disability is kind of built into it. I also protect my kids and I can now put money in their policies that nobody else except them can touch. So that means
Mm.
whether I'm dead or alive, that policy is theirs. No creditors, no predators come after it. No divorce can touch it. No lawsuit will come after it. So that built-in protection is not offered in any other product. It doesn't matter how much real estate, stocks, and bonds I buy them. It doesn't matter what structure I put it in, just the life insurance offers that much protection. So I'm a very passionate person about life insurance. Primary source of business for me because I only use it as a hedge, and a lot of my friends and family already have it. A lot of my clients already have IULs or whole life or a version of it. But when I see that somebody has no life insurance, and it's actually a lot of immigrants like us who
Yeah.
didn't learn anything about life insurance and are first, second generation in the United States, they are the ones who are usually in that category of getting life insurance. And the biggest problem I see is that they don't understand that you can actually take the money out of life insurance because the investment part of it, the creditors, predators, the income tax free nature of it, obviously the death benefit part of it, those are all just the benefits of life insurance. But the infinite banking part of it, that is in itself an amazing component. That is a tax savings component built in your life insurance that actually gives you 4% flat right now. Regardless of what the market's doing, you get your 4%. When that money starts to accumulate, you can take that money out, the investment portion of it, not the life insurance portion of it,
Mhm.
and actually go out and borrow money from your own policy and go out and buy more real estate. I've done that. I've helped
Yeah.
families do it. In fact, I've helped a few families actually even put down payments for their nice, beautiful $1 million homes. And then put the money back if they want it. And if they don't want to put the money back, that's okay too. It'll just get deducted from their death benefit. The policy stays alive.
Re-
This is called infinite banking.
Yeah, really interesting. I think it's a good starting point for people who are not doing it, and they should definitely reach out to you and learn more about
I would
how to
love
do
to
that.
help.
You have a real depth of tax strategies, right? When you work with a new client, what information do you need to give them assessment?
Yeah, I actually do a really quick intake. So I build out a secure portal. I want to see your taxation. I want to see your personal financial statement if you have one. In fact, it's a great exercise to build one if you've never had one. Then I want to see your last 12 months of statements, assets, where you're holding them, what's going on with them, income, cash flow matters. If you have a business, I want to see your P&Ls too. Like, how are you operating your business? Is it profitable? I usually find a lot of inefficiencies just in the intake process, and it helps me understand if I can take you on as a client or if I would be effective. Sometimes the clients are really well organized and they just need a couple of quick fixes where I might just give you consulting hours and a DIY decision. And sometimes
Yeah.
it's really deep, like there are operation issues on the business side, there's tax and holding company issues. Then I'll take you on as a client and we'll set up a scope of work. So first step is a conversation, an introduction, getting to know you, what your intentions are. And then I would take on the intake. I would want to see all your paperwork, all digital, of course. That's why we're able to do this in 50 states, right?
Yeah.
And then the third conversation is all about scope of work and how I can help. That's pretty much it. Simple, nothing too difficult.
Sounds good. What percentage of people that you actually turn down? For example, like when it comes across, right? And then you think either they're good or they're like too far away from getting fixed.
I would say instead of turning down, those just become quick consulting clients. I think
Yeah.
I probably rejected maybe 1% of the clients just because I would just clock it under personality. I'm a very easy
Mhm.
person to talk to, very transparent. And if I feel the personality match isn't there, it's kind of difficult to work together. And everyone should work with a person that they can easily pick up the phone and have a conversation with. So that's probably about 1% of the clients. But If I am saying, okay, you're not my long term engagement client, it's usually because you already have a really strong team. You have a great CPA on board already. They're very much hands on onto your solutions. And then I give you just a DIY consulting hours where your team is able to implement it for you. And that's a quick, maybe less than 6 months type of an engagement. And the clients that usually stay on, about 80% of my clients are long term. And they're usually because they need some fixes, transactions, some structuring help. And then once that heavy lifting is done, then they just switch to the basics, tax filing, tax compliance, and that's it. I divide my business up into consulting, execution on transactions, and taxation. So when you're first coming in, you're trying to solve problems that are not just tax filing. So I do pick up clients that just want to do tax filing with me, and that's okay too. But mostly you're coming
Mhm.
in because you're saying, my taxes are too high. I don't know where to invest. I want to build a family office. And those are the consulting parts.
Yeah. So what I heard basically is 99% of people actually comes to you will get some benefits from your service,
I
right? They
hope so.
actually have something to fix.
Yeah.
Yeah.
Yeah. Mostly.
So a lot of people are super worried about auditing. Getting audited by IRS is not a fun thing. But are those fears overdone? Have you had experience with auditing and how exactly does that play out?
First of all, I don't do anything alone. I don't work in a silo. I bring together my CPAs. I have 5 different CPA partners. I have about 6 different tax strategists, all experts in their own arena. So I've built an ecosystem of really strong, licensed people who are not afraid
Mhm.
of audits either. When we are providing a solution, it is inbuilt that we are going to help you if there's an audit. We're just going to be like, oh, it's an us problem. We're going to figure out why the audit was called. Usually, an audit is called because they want to see receipts and paperwork. And usually it's just a conversation. So, yeah, we've seen audits happen through our partners, but they're rarely a case of everything's burning down. It's usually that paperwork or that transaction, they would need more detail on it. Usually you provide details and it's done. It's rather easy. But the difficult
Right.
stuff happens when all the things have already gone wrong and then we come into play. So I had a client that had liens on his business, liens on his
Mhm.
house. The IRS was first, had the levy on his bank accounts. So the IRS was getting paid first. He was getting paid second. So when you step into and you want to problem solve at that level, that's a bigger problem, right? So that takes a little bit longer. It's a more of a mess. So for us to solve it, I don't say that that's a 6 month solution. I need a couple of years to work with you consistently to make that problem completely go away because the IRS already has their hands in your pocket. So we have taken on clients like that. We have been able to solve as quickly as 9 months and as long as 3 years. The idea is not to be afraid, but to understand what the IRS wants from you. Usually they give you recommendation letters where that means I need these things to be fixed. And that's the worst case scenario. If they have levies on you, that means you did not follow their directions. And that's when the IRS puts their hand in your pocket. So we want to stay away from that as best as possible. But if that's already happened to you, we can still help.
Yeah, sounds good. My last question
Yeah.
is there's a wealth tax right now, like being proposed in California. So a lot of people are moving states just for tax reasons. We've been noticing a lot of income tax free states getting more immigrant and getting more migrants. So does it make sense from your standpoint for people to even move their homes just for tax reasons?
I'm not going to say that I haven't recommended that. Yes, I have, but it doesn't work for everybody. We had a day trader that moved to Puerto Rico. He already had adult kids. He could move, was actually living there and doing his trades from there. I never try to say pull a wool on like pull a scam and like, IRS is not going to find out. They will. They might not find out the year 1 or the year 2, but they will because whenever you're in that gray area, eventually it'll come up. What I do recommend is if you actually have a legitimate way to move, that means now you're going to move to Vegas and just live there. Great. Awesome. It's a great friendly state for your taxation. I've had people move from Silicon Valley to Texas, Austin, right? A lot of movement happened there, especially around COVID.
Mhm.
Legitimate problems for sure can be solved by moving your domicile. But if you're a doctor, you're working in a clinic in LA, and now you bought a property in Texas to kind of offset, because now that's going to be a residence, it's not going to fly. Don't bother. It's better to legitimately understand what the IRS wants from you. And if you can move, you should move. Why not? It solves the problem. Though California is going to be really sad to see all their billionaires exit, which is currently happening. But we do need to be a little bit more friendly on taxation, which we're not. So maybe that'll teach us a lesson as a state. But it is happening. There's almost nothing we can do about it besides comply, which we are not complying. So the California 12% isn't going anywhere anytime soon. But I feel
Yeah.
let's focus on the federal opportunities, right? In the federal tax reductions, there's so much action that we can do in reducing those taxes, that the California 12% doesn't hurt you as much. So if you can't move, that's okay. But if you can, if you like the weather in Texas, go for it.
Sounds good. Yeah. So thank you for so much insights, and I've personally learned a lot. Where can people find you?
Oh, absolutely. You can find me on LinkedIn. Really easy to find me there. Or actually, I'm on all the social media now too, like TikTok, Instagram. Also, my website, it's fractional-familyoffice.com. And yeah, if you just Google Amneat Core UCLA, I should come up. Hopefully. Thank you, Austin. I appreciate your time.